The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized for 5 minutes.
Thank you, Mr. Chair. Mr. Nelson, you note in your testimony that before a Federal Reserve Bank can lend to a commercial bank, it must work out the subordination agreement with any Federal Home Loan Bank that has collateral pledged to them by that commercial bank. And obviously, this is because both Federal Reserve Banks and the Federal Home Loan Banks are required to perfect their security interests in any collateral that they attempt. My understanding is the Home Loan Bank usually will take mortgage-related collateral, while the Federal Reserve Bank will take consumer, commercial, credit card, and other non-real estate loans as collateral. And I know that the FHLB in Chicago provides regular quarterly reports to prudential regulators of its bank members about their borrowing. So to Mr. Nelson, I'll ask you first. What has your experience been with the communication and coordination between home loan banks and the reserve banks in times of crisis? And are there ways that you can think of that we could improve the coordination between the two entities?
So as you note, Congressman, for every Federal Home Loan Bank member, commercial bank, the corresponding Reserve Bank and Federal Home Loan Bank work out an agreement between them about what collateral would be pledged to the window. Because as you know, the Federal Home Loan Banks are secured not just by individual assets, but by a blanket lien on all of the assets of the institution. Consequently, the Fed can't get a perfected interest in the assets of that institution. So what happens is the two get together and they identify categories of loans that can be pledged to the Federal Reserve, and the Federal Home Loan Bank subrogates its interest to the Federal Reserve for those categories. And those tend to be ones that the Federal Home Loan Banks don't give lending value to, so non-real estate assets, consumer loans, and business loans. Now, obviously, that takes time and effort, and so it can't be done in a crisis. One change that could be considered would be to, it seems to me that a better arrangement, more appropriate to the role of the Federal Reserve as lender of last resort and the Federal Home Loan Banks as providing regular asset liability management lending, would be to flip the situation and provide the blanket lien to the Fed and take it away from the Federal Home Loan Banks.
Very good. As we take a comprehensive look at contingent liquidity and federal emergency lending issues, I would ask that we also consider the credit unions and their importance of having strong backstops in place for those institutions. In addition to FHLB advances and access to various Fed programs, credit unions have access to a central liquidity facility, a federal function maintained by the National Credit Union Administration. It's essential that Congress ensures that the central liquidity facility is up to date and ready to provide efficient and adequate contingency liquidity to the credit union system in the event of liquidity stress or some type of distress. So, Professor Scott, what's the most important reform that we could make to the lender of last resort function?
Could gentlemen turn your microphone on?
If I had to pick one, I would go back to my point on COVID. The Fed should not be getting into situations where it's doing fiscal policy, okay, as it did with the Main Street lending facility during COVID. There should be a government role. It should be Treasury implementing that policy with appropriated money or appropriated guarantees. So I think we need to get the Fed out of fiscal policy. That was the COVID lesson, wasn't SVB. But let's remember, the Fed played a huge role, okay, in lending to Main Street, lending to corporations generally, providing credit. I don't think that's the role of the Fed.
Very good, interesting. A recent report on 2023 banking crisis by the Group of 30, proposed a requirement that banks pre-position enough collateral with the Fed to support loan loss revenue loans sufficient to cover all banks' runnable liabilities. In recent remarks, acting comptroller of the currency, Sue, called serious consideration of a new liquidity requirement that would involve the pre-positioning of collateral at the Fed. Professor Scott, can I ask you, do you think such a pre-positioning requirement is a necessary reform?
I don't object to pre-positioning. If the banks want to use it, they should be able to pre-position collateral.
Thank you.
Where I would draw a line is a requirement that they.
Gentleman's time has
Thank you, Mr. Scott.
expired.
Yield back.
The gentleman from California, Mr.